Your tax return is like a photograph. It captures one moment. It cannot be changed. It can only be filed. Tax planning is a blueprint. It shows what to build. It guides every decision before the structure exists. It is reviewed, revised, and executed across the year. Most CPAs deliver photographs. Strategists deliver blueprints. Most owners pay for the photograph and never get the blueprint. They do not know they are missing it because the photograph looks complete. It has numbers, it has signatures, it has a refund or a balance due. It feels like the work is done, but the work was never started. The work happens months earlier, before the year closes, before the income is realized, before the structure is locked in. By the time you sit with your CPA in March, the blueprint phase is over. You are looking at a photograph of what happened. There are 5 tells that distinguish a CPA who files from a CPA who plans. If your CPA fails any one of them, you have a record keeper, not a strategist. Tell 1. When does the conversation start? A record keeper calls you in March, maybe February if you are a high priority client. A strategist calls you in May, August, and November. With him, you will have 3 or 4 conversations a year. In each call, he will look at what is changing, what windows are open, what moves to make before December 31st. If your CPA only calls you in March, you have a record keeper. Tell 2. Do they project or do they report? A record keeper reports what happened. A strategist projects what will happen and then changes the inputs. Income projection, bracket modeling, equipment purchase timing, retirement funding, Roth conversion sizing, charitable giving acceleration. If your CPA does not run a projection at least once a year, you have a record keeper. Tell 3. What does your CPA ask for? A record keeper asks for documents like K-1s, 1099s, and receipts. A strategist asks about the business. What changed this year? What is changing next year? Who is on the deed? Who is on the cap table? If your CPA only ever asks for documents, you have a record keeper. Tell 4. Do they coordinate with your other advisors? A record keeper works alone. They never speak to your attorney, your financial advisor, your bookkeeper, or your insurance agent. A strategist quarterbacks. They run the team. They make sure the trust matches the LLC, which matches the tax return, which matches the estate plan. If your CPA never coordinates with anyone else, you have a record keeper. Tell 5. When you ask why a strategy works, what answer do you get? A record keeper gives you software output. A strategist gives you the rule, the internal revenue code section, the treasury regulation, the case law, the audit history. If your CPA cannot tell you why a strategy works at the level of the underlying rule, you have a record keeper. If your CPA fails you, you do not have a strategist. And without a strategist, your tax return will be a photograph for the rest of your life. Now here is what most owners do not realize. The cost of having a record keeper is not visible. It does not show up on the return. It shows up in what is missing. The QBI deduction you did not get was because the salary was wrong. The bonus depreciation you did not capture because the equipment was placed in service January 5th instead of December 28th. The Roth conversion you did not run because nobody projected the bracket. The HSA you did not fund because nobody mentioned it. The S-Corp election you did not file because nobody analyzed it. Each of those is a number, sometimes a small number, often a 5-figure number. Add them up over 5 years, and the cost of a record keeper is 6 figures. And the record keepers are not bad at their job. They are doing their job exactly, filing what already happened. The problem is that you needed a different job done. You needed someone working ahead of the year, not behind it.
One Big Beautiful Bill Act
made this gap bigger through the Public Law 11921, signed July 2025, locked in permanent tax brackets, and restored 100% bonus depreciation. Permanent rates mean a longer planning horizon. Bigger depreciation means bigger windows. Both reward strategists CPA more than ever. Both punish the record keeper more than ever. If your tax planning is happening in March, you are leaving real money on the table. Every year. Not because your CPA failed, because the system you bought into was a snapshot system, not a planning system. 5 tells. Run the test on your CPA. If they fail any one, ask yourself whether the photograph is what you actually wanted, or whether you needed the blueprint all along. If you want to know whether your CPA passes the 5 tells, comment strategy, and we will walk you through how a full structure review works.